Inflation continues to trend down as headline inflation came in at 7.1% today, lower than 7.7%, which was last month's reading. Can this trend continue? And the stock markets, which reacted positively today, can that bullish momentum continue as well? How exactly will the stock markets trade into 2023 and beyond? We're here to answer this question and much more with our next guest, Jason Shapiro, veteran trader who's been on the show before, calling for the stock markets to flatline for the next 10 years. Jason writes for the crowdedmarketsreport.com and has also been featured in Jack Schwager's new trading book, Unknown Market Wizards. Jason, welcome back to the show.
Thanks for having me.
Now, last time you were on the show, a few months ago, we were talking about how you think the stock markets aren't going to recover to the previous all-time highs for another 10 years or so. And of course, we've seen precedents of this happening before. The NASDAQ, for example, didn't recover to its pre-2000 high until 12 to 14 years later. So I would like to revisit that call a little bit, but first I want to focus on the short term before we get into the long term. Jason, you are known as a contrarian trader, meaning you trade against sentiment. How are you feeling the sentiment is right now with the stock markets?
I think sentiment for the stock market right now is horrible. I'm trading from the long side and have been for a while here. I think that there's a major consensus out there right now that there's a recession coming next year, and therefore the first half of next year in the stock market is going to be very bad. And then possibly as people start to discount the end of the recession, the second half maybe next year will be better. I personally think it's going to be the exact opposite of that. And I think that the time to be long is now. And once people jump on the train later in the year, I think that will be the time to get off. So Right now, I think the trade is long stocks.
Well, let's talk about the technicals first. Let's drill down on the technicals. Now, we have had a return to 4,000 points on the S&P 500. That was a key psychological level that we needed to break. Some people have said to me that this is the key support. And once this is broken, it's just uphill from here. Would you agree or disagree with that statement?
I think that the key technical thing going on here is there's this huge sort of downward sloping trend line in the S&P 500 that we're bumping up against right here, right now. I believe that that is going to be broken to the upside. And once that's broken to the upside, there's going to be a lot of trend following type trading going on, a lot of short covering type trading going on that is going to push the market through that trend line and higher. Whether it's going to reach all-time highs, I don't know, but I would have to think at least 44 to 4,500 on the S&P should be a target. Okay.
What macro factors are you basing this upside target on?
I don't really base it on macro factors. I base it on what other people are basing their trading macro factors on. And the macro factors that they're believing in very strongly is that there's going to be recession, and that recession is going to cause the stock market to go down. I'm not going to sit here and argue whether or not there's going to be a recession. I have no ability to make economic predictions like that. I could argue that there is not going to be a recession, but that's not really the point. The point to me is, let's say there is going to be a recession. Does that guarantee that the stock market has to go down? I don't really think it does. It depends how people are positioned and thinking about it going into it. So this is why I'm bullish the stock market. And God forbid there actually isn't a recession, which, by the way, there has been no sign of as of yet. People are counting on a recession to then bring down earnings estimates and earnings, and that be bearish for the stock market. I think that's what people have discounted into the market right now. So if we don't have a recession and we don't have earnings come down, then, and on top of that, if people are preparing for recession, like CEOs are preparing for a recession and we don't get one, then they're actually going to have to jack up production to catch up for what they've prepared for. So we'll probably get some kind of economic growth into that. And if and when that happens, which we won't know for 4 to 6 months, then people will go crazy getting long the stock market, and that's probably when I'll be giving it to them.
Sorry, you don't see any signs of a recession, Jason? Just based on your own personal observation, as well as perhaps...
I mean, from my own personal observation, I don't go out very much, but when I go out, I see every single restaurant and every single store totally full. And I have people on my Discord page from all over the world who are telling me the same things about every country that they live in. I got a guy in there from Dubai who's lived in Dubai for many, many years. He said he's never, ever seen it like this. how crowded it is, how crowded restaurants are, how crowded stores are. So either people are going for one last humongous party here before a recession comes, or there's a whole bunch of money and disposable income out there that is not being captured.
I was just talking to, it's a personal anecdote, since we're sharing personal anecdotes. I was talking to somebody who worked at a convenience store last night, and I asked him, how was business? Are you going on vacation? He said, I'm not going on vacation anytime soon because all the trips I want to go on to the Caribbean, Cuba, tropical places, they're all prices are all jacked up. He said it doesn't make any sense right now. Are people just price gouging? They're taking advantage of the fact that people want to travel right now. I said maybe next year if and when things slow down. But yeah, from that perspective, you're right, Jason. It seems to me that people are still traveling and people are still, vacation packages just so expensive. People are out and about. But why is there this narrative that people are concerned, people are worried? We are seeing some indicators of some worry building up. Personal credit card debt is piling up. Personal savings rates are going down. Why do you think that's happening?
Yes, I think those are the ones that cause the worry, because there's no question about that. Personal saving rates are hitting lows. Personal debt is hitting highs. Although I was looking yesterday, the last time that personal savings rates was this low was in 2005, and the stock market went straight up. You know what I mean? So I'm not an economist. I can't forecast economics. It's a head scratcher to me, just like it is to everybody else. But I try to deal with the world as it is, not with the world as I seem to be able to, as I want to predict it to be in 6 months to a year. And all I see at this point right now is the opposite of recession. As you said, I've never seen anything like it. The amount of people that are out and about and spending money is incredible.
What about the housing sector? Even the Dallas Fed is projecting a further decline in housing prices across the country by the order of perhaps 15 to 20% if things get really bad, the latest report said. Mortgage rates, of course, are going up, as you know, and some people will have to cut back on spending because their variable rates have gone up and their monthlies are going up. So that's less money they have to spend on discretionary items, right? Is that a concern?
So we're told, has the Dallas Fed ever been good in their predictions about the housing market? I don't know. I'm not saying that they have or they haven't. I'm saying I don't know. I'm saying ever since, look, rates have gone up a lot. Yeah. Has housing prices have gone down? I bought the house that I live in about 3 years ago, and the broker that I bought it from calls me up every few months and asks me if I want to sell. I'm like, what, you can't find a house to get people to buy? I mean, I don't get it. I haven't seen prices go down. So again, maybe people are just drunk and they're going to go down 20 or 30%. But there's certainly no sign of that now, and interest rates have gone up. So, and are interest rates going up more? It certainly doesn't seem that way. It certainly seems like we're more towards the end of the cycle than the beginning of that cycle. So if their housing prices aren't going to go down while interest rates went up, then when are they going to go down?
Perhaps prices are lagging. The Case-Shiller home price index has fallen a little bit, but it's nowhere near the 2008 dramatic crash that we've seen, back in the last recession. I think maybe in some jurisdictions prices have stayed stable. Maybe in other jurisdictions they've come down a little bit. But you're right. On the whole, we haven't seen a huge housing collapse yet. But let's speculate going forward. Do you think that day could come that you and I could have a conversation and we'll be talking about a very different fact, the fact that housing prices have gone down?
Could that day come? Yes, of course that day could come. Should that day come? Yes, it should come. Will that day come? I have no idea. You know what I mean? I trade the markets as I see them, right? And right now I don't see it, right? Mm-hmm. We'll know. We'll know when the time comes, and I do think the time comes. I'm a long-term bear, and if I'm a long-term bear, then I do believe that's coming. But I just don't think it's coming until people give up on believing it's coming. So again, you get some kind of squeeze up in the market here. You get the Fed stop raising rates for a while, blah, blah, blah. Then people will give up on this whole recession idea, and I think that's when it will come. Things don't come when everybody's preparing for it to come, right? It's all reflexive. So when they're not preparing for it to come, that's when it will come. That's what I believe.
Inflation data came out today, Jason. So 7.1% headline inflation. It was slightly lower from the consensus expectation. And so, you're seeing inflation coming down. You're seeing inflation not meeting expectations. Perhaps that might be a good sign, or perhaps that might just incentivize the Fed to, pull back on their rate hikes. What do you think?
Yes, I think it will. And the headline number 7.1 is an annual number. If you annualize the monthly number, I think it's more between 2 and 2.5%. So if you're looking at 2 to 2.5% inflation, then the Fed doesn't have to raise rates at all anymore, right? The question, of course, will be, then what? Does inflation stay here, or does it start to pick up again, right? And obviously that's the question that everybody wants to know, and nobody will know until it happens. But as of now, it seems like they've done the job of getting it under control. Money supply has gone down a ton, right? Yeah. And that's really what inflation is a function of the money supply, right? So they brought money supply down a ton, and so they're bringing inflation down. So there you go. So now people think because of that, the next level is recession and all that. But until there's some signs of that, I just can't believe that. And maybe the signs will just all come at once, and but I still think people need to give up on the idea first, and then it will come. Okay. It's so consensus right now. I keep saying, and this isn't an economic thing, it's more of a market thing, because I don't trade contracts on the GDP growth. I trade contracts on the S&P or whatever else, right? So it's more of a market thing. Until people in the market give up on this idea that recession is coming and the market's going to go down because of that, I don't think it's going to happen. And when they give up, then there's a much higher probability of it happening. So
do you think that there will be certain sectors next year that will outperform others? If, let's assume that inflation continues to fall, assuming that margins improve across all sectors, there must be a few sectors that will do better than others.
Certainly. There's always certain sectors that do better than others. For me, again, as a sentiment guy and as a contrarian guy, I've listened to people, and this goes back to the idea of trading the last bull market. The real leaders in the previous bull market up to 08 were bank stocks, right? Because of the whole mortgage thing and all that, and banks were growing and they were expanding everywhere, and they overexpanded and then they crashed. And this whole bull market, all I've heard is people say, buy the bank stock. This whole last bull market, all I've heard is say, buy the bank stocks, and the bank stocks are going nowhere. Citibank is still, I don't know the number, 70% lower than it was in 2008, right? And now, because of this coming recession thing, suddenly all those people that were bullish bank stocks and got nothing out of it for the last 12 years or 14 years, they've all given up and they're all bearish banks now. So to me, my favorite sector, I don't trade sectors, I don't trade individual stocks, but if I were, from a contrarian point of view, banks. And I haven't liked banks in 15 years. I'm saying banks, if I were going to pick a sector that's going to outperform from here.
Don't banks usually benefit from rising interest rates? Are you assuming then that interest rates will continue to rise despite perhaps falling inflation?
I think that banks benefit. I think the theory goes, banks benefit from a yield curve steepening, right? Because they borrow short and they lend long and they make the spread, right? The yield curve is not just flat now, it's inverted at almost, biggest 40-year inversions, right? I think that is going to flip as people flip from their idea of a recession is coming to their idea of maybe not a recession is coming. I think the yield curve will then steepen, and that steepening will support the bank stocks. Mm-hmm. Okay. That's the contrarian trade here, I can tell you.
Generally speaking, how does one execute on a contrarian idea? At what point this is just trading strategy now, at what point do you look at the markets and you say to yourself, it's time to go against the herd? I mean, the herd isn't always right, of course, as we know, but they're not always wrong either. At what point do you differentiate between when the herd is right and when the herd is wrong?
I think that's a good question. So I believe that the herd is right for periods of time and wrong over time. So you don't want to get caught up against them in that period of time that they're right, right? So really, for me, how I do it is I'm waiting for market confirmation I don't make any trades unless, I can have a million thoughts about this, that, and the other thing, but I don't make a trade until the market confirms what I'm looking to do. So what does that mean? Well, let's say I'm looking to get long banks for those reasons that I just decided, right? So am I just going to buy banks today because I happened to come up with this idea this morning? No, I'm not going to. I'm going to watch the tickers and I'm going to watch the banks, and I'm going to watch them when they start to perform well. Let's say the yield curve continues to go negative, and yet the banks outperform. They shouldn't be, but they do. That's when I will do it. So that's the market confirming what I'm thinking against the consensus thought. So consensus thinks yield curve going negative, negative banks, and yet the bank stocks outperform. That's when I'm looking to go with it.
I will mention that the banks across the board, Morgan Stanley cutting staff by 2%. So is this an indicator of them going through a tough time, or are they just becoming leaner and trimming down fat, so to speak? In other words,
I think everybody is preparing for the coming recession. That's what they're doing.
Which
right?
you don't think is happening. So
it's not a question of I don't think it's happening. I think that if you've already prepared for it, then a market. It's not a question of whether the recession comes, it's how the market reacts to it and what the market's going to do, right? So if everybody's already prepared for it, then I don't know what the upside to trading that is, right? There's much more upside to trading against that, in particular, once the market confirms what you're saying, right? Like now, just in general on the S&P, we're going to break, I don't know where we're going to close today because it's a pretty volatile day, but we're most likely going to break through the upper end of this resistance level, right as everybody's talking recession. So that's the market confirming the contrarian trade to me. So,
At what point would you see this, because you did earlier in the interview give an upside target, at what point do you think that the market will reverse trend and go back into a bearish phase? You did mention to me that long-term you think that you're bearish. Long-term you think that the S&P 500 and other stock indices are going to stay relatively flat, not retrace their previous all-time high. So my question is, what indicators would you look for a reversal of a bull trend?
So I will be looking at the same things I always look at, which is A, positioning, which right now has people short stock indices. When that flips to have them long, I'll be looking to go the other way. When I start to hear the same people that are guaranteeing essentially recession coming next year, when I hear them giving up on that idea and saying, oh, it actually looks like that we're having growth instead of recession, and now we have to make up for that recession thought, so everybody, we're going to have strong growth. When they start saying that stuff, then I'll be looking to go the other way. So they're going to have to flip from this recession thought to a non-recession thought before I'm going to start thinking about getting short. So we're probably a good 3 to 6 months away from that, I would think.
All right. Now, do you think there's anything that the Federal Reserve can do that might flip the markets in either direction?
I mean, sure. They move the markets, but what are they going to do at this point? It seems like they're going to, at the very least, pause on interest rates. And then the next big question will be, what's next? If the economy starts to weaken, then are they going to cut rates? Or if the economy never ends up weakening and gets stronger, are they going to raise rates? And that is my guess. And that will probably be the catalyst for the next leg down. Right? People will get excited about the fact that the economy is not going into recession. It's actually in growth. And then all of a sudden it'll be like, boom, well, now the Fed has to raise rates again. So that's going to crush it again. That's my thought of how it will look.
Okay. All right. Jason, finally, give us some more trade ideas besides financials. We know you like banks, but in the short to intermediate term, how should one be positioned to take advantage of this next bull phase, however short-lived or long-lived it may be? Do you recommend just going to stock indices? Do you recommend allocating to certain sectors? What are some instruments?
I think being long the Dow is a good idea. I think being long some of the commodities, crude, cotton, those type of industrial commodities are a good idea. I know people are starting to love gold and silver. I'm not against being long gold and silver here. It's not my favorite trade of all of them, but that's not to say it won't work. But I would prefer things like crude and cotton and those type of things. And the Dow, it's more industrial type of stuff that I like here. Mm-hmm. The NASDAQ, If the market's going to go up, the Nasdaq probably goes up. But again, I don't like to trade the last bull market. I like to trade the next one, and I think the next one is industrial based, not tech based. To me, there's just way too much trapped money in these tech names. People spent 15 years piling into these tech names, and I think it's trapped. I'd rather be in the stuff that they're not in. How many people have bought, the Dow or the DAX, stuff like that in the last 10 years? I would argue not very many. And that's why those are outperforming here. Well,
Jason, I do appreciate your candor, and it's not easy to be a contrarian and stick your neck out there and go against the herd. So I do appreciate that. You've been right before. So thank you for making this call again. We'll follow up in the new year. In the meantime, how can people follow more of your work? You do write for creditmarketsreport.com. Give us a synopsis of some of the reports that people can write.
So creditmarketreport.com is a webpage we started for people that were interested in learning about contrarian trading and learning about being disciplined about trading and learning about risk management and all that. That's a place you can go. We're also on YouTube. I do videos like once a week. I think it's also under Crowded Market Report on YouTube. So I do some videos on there that people can go and check out too and see if they like it.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.